Okay, I'm going to tell you now. This is a hard one. If you can get this one, you can do anything, ladies and gentlemen. I sold some inventory to a customer, $90 cash. I'm glad to see cash is there. The cost of the inventory was $75. Okay, what's involved here? Well, we got some cash, and we got less inventory. Cash went up, and inventory went down, so my cash and my inventory are involved. I've got a revenue account. Why am I getting this cash? Because I did something for a customer. I generated this cash through doing business. So I've got sales revenue involved. Revenue's the amount of assets generated in doing business. And now I got an expense involved too. Expenses are assets consumed in doing business, and the particular name of this asset is cost of goods sold. Cost of goods sold is an expense. And you say, well, I wish the word expense was in the title. Yeah, don't we all wish it, but it's too late. It's already said. It's the cost of goods sold. It's an expense. Cash and inventory are involved, and I've got a revenue and expense involved. Okay, what went up, what went down? Let's think that through. Well, the cash went up, of course. People gave me cash, but they didn't just give it to me. In exchange, I had to give them some inventory, so my inventory went down. All right. Now, what happened to the amount of assets generated in doing business? That's what revenues are. Well, it went up. I have more revenue, but I also have more expenses. I mean, if people are going to give you money, they're going to expect something in return. In this case, what I had to give in return was some inventory. So I've got more expense. I've got more cost of goods sold expense. My revenue went up, but my expenses went up. You got to spend money to make money, for heaven's sakes. So I got more revenue, but I also have more expenses. And what we hope is our revenues are going to be more than our expenses. We'll check that. We suspect that that's true, but we'll check that in just a minute. Let's convert this now into debit and credit language. And we see that our cash went up. That's with a debit. Our inventory went down. That's with a credit. They're both assets. Sales revenue goes up. That's with the credit. Remember, sales revenue is an equity account. When we have revenue, our equity goes up. Expenses are just exactly the opposite. More cost of goods sold means less equity. More cost of goods sold, or any other expense, means less equity. So we debit expenses. Now you're going to say, wait a second. We debit cash when it goes up. We're also debiting expenses. I thought debit meant good. Well, if you thought debit meant good, guess what? You thought wrong. Debit means left side of the page. And when we're talking about assets, debits mean our assets are going up. When we're talking about expenses, which are equity categories, debit means more expenses, which also means less equity. Let's see what this looks like in a journal entry. And here's the last thing. If I were you, and I'm suggesting strongly, do this as two separate journal entries. Do a revenue journal entry and an expense journal entry just like this. It makes it so much easier. If you try to shoehorn this all into one big, grand, spanking, marvelous journal entry, you're going to go wrong here. Asset cash goes up with a debit. Beautiful. And where did that asset come from? It was generated through doing business. So the equity account, I'll just put EQ account for equity, sales revenue, represents the fact that our equity just went up. People gave us cash. It came out of thin air. It's beautiful. But that's not the whole story. Our asset inventory went down. So inventory goes down. That's shown with a credit. And why did that inventory go away? Well, that was consumed in doing business. That's an expense. Expenses are equity accounts. More expenses mean less equity. So the reason we're debiting cost of goods sold is we're showing that our equity went down. Revenues cause equity to go up, so they're credits. Expenses cause equity to go down, so they're debits. And we see here, did we make any money? Yeah, because when we compile an income statement here, we're going to have revenue of 90 and cost of goods sold and expense of 75. The difference, the gross margin or gross profit, is 15. But here's one last thing on this one. You're going to be tempted. You're going to want to somehow show, okay, we had revenues of 90, expenses of 75. I somehow sense that we have a profit of 15, and you're going to want to show that profit in the journal entry somewhere. No. Don't do that. The profit will come out in the income statement. We don't have to do everything here. Let's just get the raw data down, and we'll let the income statement show how much profit we made. We're going to record the revenue with a credit of 90 right here, and we're going to show the expense with a debit of 75 right here, and the profit will come later when we compile the income statement. Don't try to put the 15 in the journal entry. If you do, you're going to get it wrong.